Hello, I'm Mitch Goldberg. You're watching my live stream called Be the Boss of Your Money. Thank you very much for joining me. I realize your time is very valuable and I appreciate you spending some of it with me. We've got a few things to cover today. First, we finally have had the first big down day in the stock market this year. And in fact, in the last few months, wiping out any gains in the S&P 500 so far for the year 2021. So we're going to talk about that. What happened? Why is it so bad? How much worse can it get? The next thing we'll talk about is something that has to do with just this incredible fascination. And that fascination is all about GameStop. What's going on with it? It's not just GameStop. There are a bunch of stocks that are caught up in this frenzy called a short squeeze, and it's pushing stocks up in height and speed that we have not seen before. Some people are making fortunes and some people are losing fortunes and everything in between. We need to connect the dots. How does that affect the stock market? How did this happen? And is it something that you should pay attention to? Or is it just a fly-by-night thing that you could basically ignore because it has nothing to do with your financial goals? Then the last thing we'll talk about is a special kind of timing. People talk about market timing, timing the market, time in the market. I'm talking about timing for my clients' goals. That's a different kind of timing, and that's the kind of timing that I obsess over, and I want to share that with you. So let's roll the introduction. We've got a good show here. You're watching Be the Boss of Your Money. Let's get to the intro. This is going to be quick, and we're getting into all this good stuff right now. Hello, welcome to Be the Boss of Your Money. This is my live stream. I do this every Monday through Thursday. I do this live, and then you could check out the replay immediately afterward on Facebook, LinkedIn, and YouTube. And if we're not connected on any of those platforms, please feel free to send me a connection request, and we'll hook up there. It'll be a great thing, and this way you could follow all of my content. I create content that's educational almost on a daily basis. Thank you for joining me. If you're watching this in the live stream, feel free to ask me any questions that you have about the topics that we're discussing today in the comments. If you're watching this in the replay, certainly hit me up with your questions as well. I will see them. I'd love to hear from you. That to me is actually the most fun part of doing this whole entire live stream. So it's a national fascination, the stock market. It's a national fascination, what's happening with GameStop and other stocks of the same lower quality ilk that are trading much, much higher. And we need to just take a look, slow down, and see what's going on. And I want to talk to you about the most important thing I do, because in a sense, I know what comes next for you, for my clients. I'm not clairvoyant. I don't know what they're going to have for dinner in 2 nights. I don't know their expiration date, but I do know more or less what's coming down the pipe for them in terms of Social Security, in terms of benefits, in terms of what they'll be going through in retirement, because I have over 30 years as a financial advisor working exclusively with what you would call retail clients. That, my friends, includes you and me. So let's take a quick look. Today, we finally had the first substantially down day in the market. Let's do the quick share screen. If you have any questions, hit me up in the comments. Words of wisdom, words of encouragement are always appreciated. We'll do the quick share screen, show you a couple things, and I want to just keep this whole thing rolling today. You see today the Dow is down 2%, down over 600 points. Hey, listen, 600 points on the Dow, that certainly gets my attention. But it's a 2% down day. We've had many days like that in the past. We just haven't had one for I don't know, a few months, maybe 2 months, 3 months. What's the difference? The point is 600 points. It just ain't what it used to be. 600 points used to be a disaster. But today, We're still over 30,000. We'll see. Another day like this, we'll be under 30,000 on the Dow, but that's not really the important thing. The S&P down over 2.5%, NASDAQ down 2.6%, the Russell 2000 holding up a little better, still down, not down as much, down just a little under 2%. But the big spike is the VIX. This is a huge jump on the VIX. We've been talking about the VIX, the fear gauge. This is basically what professional money managers are willing to pay to hedge their portfolio. So when it goes up, it's an indication that worry is piling up. And when it goes up this much, this fast, historically, that means worries are piling up very quickly. And you can see here that the VIX went up 14.61%. I mean, the way the VIX went up today, you would think that's like a short interest stock, like another GameStop, Bed Bath and Beyond, or BlackBerry or AMC Entertainment, which we're going to take a look at in a little while. But the VIX was up huge, and it was up. It was below 30 for a while, then below 25, and we wanted to see it get below 20. The fact that it's not even close to 20 does not, in my opinion, forebode well for the very, very near term. Apple, though, as you can see on the screen, reported a blowout number. So maybe that'll help the stock market recover just a little bit. But let's take a quick look at the stock. Apple delivered its largest quarter by revenue of all time on Wednesday. These numbers, by the way, just came out. These numbers just came across the tape. Okay. And with those incredible blowout numbers, just a wow of a number, the stock is down 79 cents after market trading. I would have expected a better day today because Microsoft, they increased their revenues. Their fourth quarter numbers came out yesterday. Quarterly revenues up 17% year over year. For a giant like Microsoft, $2 trillion valuation like Apple, for these companies to grow their earnings and revenues as much as they did in spite of their size is just, it's an economic marvel to me. And yet the stocks went down. So a lot of good news was factored in. I think the Wall Street investors, the market takes a breather here. I'm not particularly alarmed of anything major changing a major course of action. Federal Reserve Chairman Jerome Powell spoke at length today, and he basically said, "Hey, we're keeping rates, ultra low through 2022 into 2023. We are not moving until we see inflation above the 2% for a while." And he wants to go by like a long-term historical average of inflation, not just like, oh, if inflation pops up to 2.5% today, we have to raise rates and take away accommodation. No, he said if inflation goes up to, let's say, 2.25%, for example, we're going to average it out over the last couple of years, and it's still going to be low. So we've got the accommodation, and that's why I'm confident that the market's taking a breather here, not a maybe a correction. It could be, but it's not an end to the rally. Okay. He also expects to see an uptick in business, and this was I'm going to go on, but this is the most substantial thing that Jerome Powell said today. He said, even if we see an uptick in business in the economy second half of this year, which is something we've been talking about because people have their COVID vaccines, we start getting back to experiences, restaurants, hospitality, just living our lives again and spending money. He said that even if we see a spike in inflation, he expects that spike to be transitory, not long lasting, and not that big of a deal. Wow. So that kind of removes a lot of worry about the second half of this year. Investors have a lot to celebrate, and earnings have been very good. Like we saw with Facebook just came out with earnings, Microsoft yesterday, Apple today. It's just that stocks have been up so much in the last few months. They were due to take a breather, and we finally have it, and that's okay. It's a healthy sell-off. Let's not be alarmed about it. I'm not making any changes to anyone's portfolio because of this. Let's take a quick look at a couple of other things, and then we're going to, we're moving through this pretty quick, folks. Stay with me. Stay with me. Hit me up with your questions, your comments. You want to see something cool, everyone? Watch this. Watch this. Hey, I'm over here. Look at that. Can you believe that? I can do multi-camera, and now I'm over here. I'm over here. I'm over here. All right. Just a little something I've been working on. I've been adding a lot of new technology to my whole sound system, to the audio system, to the video system. And I've really brought up a lot of improvement, a lot of advancing in the live stream, a lot of new technology. So I hope you are enjoying the experience. I hope I sound really well with this incredible Shure MV7 mic. It's connected now to a mixer, which goes into a switcher. And I'm coming to you not just on webcams, but on HDMI outs because I'm using Canon cameras now to stream this. And I have another camera on the way. So let's go on a little bit. Who's out there? Judy gives me the heart. Here we go. Okay. Let's take a quick look while we're okay. Apple is up 15 cents after market. Let's take a look at Facebook. Come on, Facebook, where are you? I hate when that happens. And that sometimes happens, with the white screen because when you're live streaming, it makes your computer run a little slower. And that's okay. We'll get to this in a little while. Okay, so I think we're just about back. Come on, guys. All right, we'll take a look at the watch. I go over this every single day, as you know, if you're a watcher of the show. Let's take a look at the 11 sectors of the economy. Real estate, the best performing sector of the economy, and we're still down. I didn't say that the best performing sector has to be up, but the stock market as measured by the S&P 500 is now in negative territory for the year. This year's gains have been wiped out, so it looks like a not so great January. And some people do say as January goes, as goes the year. We'll see if that holds true, but I won't know for about another 11 months. Okay. We could predict, but predictions, you know what they're worth. Industrials were off a little. They were off yesterday. Financials were off a little. They were off yesterday. Not a little, almost 3% on financials. Communications. It was just a lousy day across the street. Not a death knell, but it was a lousy day in the street. First lousy day in a long time. If you just got into stocks in the last few weeks, you are probably hurting a little bit. But if you're a long-term investor and you've been investing consistently throughout the pandemic and before the pandemic, you're not going to really, I don't think you're going to really notice a whole hell of a lot in your account values. Okay. So do we have anything else up here? All right. We don't really need to look at all these things. So let's just, okay. So here's Alphabet aftermarket trading down 13. Facebook was off a little last I checked, and I want to talk to you about the next big thing, GameStop. So GameStop closed over $300 a share today, and it's really just the most remarkable thing that I think I've ever seen in my 31 years of doing this. And if you take a look at how much the stock went, how much it went up. Stay with me here, folks. This is incredible. The stock went up $199.53. So up $200 per share in one day. And we're not talking like a dollar stock that went to $3. This company was a $2 stock. You can see where I'm moving my mouse. It was a $2 stock at its 52-week low. This stock is not up because of the soundness of the financials of this company. It's not up because, if you think of it, is the company an innovator where they could afford to lose money and investors will give them the benefit of the doubt because they have new innovations coming out? No, I don't think it's that. Is it an undervalued play? No, I don't think it was down because it was undervalued. I just think it was down because retail is having a very tough time and people buy their games online. Okay, I know my kids are major gamers. They don't go to GameStop to buy games. So is it? It's not an innovative play. It's tough to see how it's a turnaround play. It's not an asset play. In fact, the company lost about $750 million last year. So this is what's happening. The stock is heavily shorted, and I came up with a new term. So it's been going around on Reddit and other chat boards about GameStop going up, and someone said, "Hey, I'm not selling this stock until it's 1,000." All kinds of stuff is going on. But what it appears is I call them the short interest vigilantes. So it's a heavily shorted stock by professionals who see the stock as trading lower, if not worthless. When the stock, let's say, was at 10 or 15 or 20, because the fundamentals are deteriorating and the company's future as an ongoing entity is questionable. That's no secret. But what the people who are playing the short interest stocks with big bets that they're going lower, are going into these stocks en masse as like groups of people in a what I believe is a coordinated fashion. And when these stocks go up, people who are betting that they're going down start to lose money. And the only way to get out of those short positions is to buy back the stock. So that creates more buying power, which puts more upward pressure on the stock, upward pressure. And that keeps happening. And the more it goes up, the more pressure it is on short sellers to cover their shorts, buy back the stock because they're losing so much money. So if you buy a stock at 20 and it goes down to zero, and let's say you bought 1,000 shares, you lost $20,000. That's the most you could lose when you buy a stock. But what if the stock goes from 20 to 40 and you were shorting it? You thought it would go to zero. Maybe that's in my example. I'm not saying that's what GameStop is saying is my example. If the stock went to 40, you'd be down $20,000. But what if then the stock went down to 50, went up to 50, and it went up to 60, and then 100, and then 200, and then 300. Now you're down six figures. So the brokerage firm that you use, whether it be a Robinhood, a TD Ameritrade, a big brokerage firm, a full service brokerage firm, whoever you use, they're going to say to you, hey, you are down so much, and we're afraid that when you take this loss, we're afraid that we're going to have to share your loss because you lost money. You have to put the money into the account. It's called a margin call. You don't have to put all the money that you're down, but you have to put a lot of money into your margin account. And if you don't, then the brokerage firm is on the hook for that loss. Firms could go out of business for something like this. That's happened in the past. So now these firms are just getting you out of the positions, whether if you like it or not, by buying back the stock to cover the short, and it pushes the stocks even higher. And the question is, if investors are losing so much money, the professionals who are shorting GameStop, they have to come up with cash very quickly to give to their brokers to pay the brokers back. So what do? To get cash? They sell their Microsoft stock, maybe they sell their Honeywell stock. They sell stocks. They sell other investments that are good investments, but they're selling something they can sell, not necessarily what the best thing is to sell. And that causes the rest of the market to go down. So that's how something like this could become systemic, and it could impact brokerage firms that could actually go out of business because of this. And then in turn, those brokerage firms could be on the hook for other financial institutions who then would have to potentially take a big hit to their cash, to their balance sheets, and then they might need a rescue. So it could spiral out of control if the situation gets too big. And it's not just GameStop stock. It's BlackBerry, it's AMC Entertainment, the movie theater company. It's Bed Bath & Beyond. It's Express. There's a bunch of low-priced, small-cap stocks with big short positions that what I call the short interest vigilantes. If you take all the stock in a company that's being shorted, that's called the short interest. If you take the short interest, the short interest vigilantes who look like they're ganging up on companies that I just described, small, low price, small cap, big short interest, and they're coordinating an effort to start buying the heck out of these stocks. It's also scaring the heck out of the professionals who are short these stocks, because now they have to think like, I never thought this could happen, but that's a new risk that I have to take into consideration. So that's what's happening with GameStop. Now we've got a couple of people out here. I thank you very much. Let's take a look. We've got a couple of comments. Okay, who is out there? Hey, John Robertson. Thank you. Congratulations on your business growth. Hey, buddy. Thank you very, very much. And thank you for being part of my journey. And I love being part of your journey. And you are a good friend. And that is a really sweet thing to say. Thank you. Thank you very much. That means a lot to me. And who else do we have? We have Michael Fisher. Hey, cousin. Hey, cousin. How are you? It's a good thing for Facebook, but one of these days we have to actually get together in person. All right. So nice to see you, man, and thanks so much for taking the time. And I'm really touched that you're watching this, Mike. I really am. Thank you very much. And we've got Eric out there. That's awesome. We want to see more of you. Well, you know what? I want you to see more of me too. So thank you very much. And let me stop the share screen here. Thank you very much, Eric. That is really sweet, and you're the best. Thank you very much. By the way, Eric creates really nice, really great content. So track him down on LinkedIn. He's also a financial advisor. All right. So the last thing we're going to talk about is timing. This is a personal finance matter because this show is really about personal finance, which includes investing in the stock market and all that, and that takes up a lot of time. But I want to talk to you about timing in the market. I'm not saying I'm coming out here to condone that you time the market. No. That's not what I'm saying. Let me see if I can switch angles. Oh yeah. So I'm not saying that you should time the market and try to get into the market and out of the market and back and forth. That's generally speaking, that might work for people a couple of times, but overall, you just have to be wrong once, and it wouldn't have been worth it. So I'm not talking about timing the market, but what I am saying is I don't obsess about the stock market. I know where the stock market is at all times. I've been covering the stock market for years. I've written a ton of articles, many articles I've written for CNBC, and I'm quoting a lot of media outlets. I mean, I know I'm sound like I'm bragging, but I'm not. I'm just saying this is something I'm very familiar with, and this is something I cover for my entire adult life. So I'm not saying time the market, but what I am saying is I obsess about timing something else. I obsess about the life cycle, the timing of the life cycle transitions for my clients. Okay. That's what I obsess over. The life cycle transitions of my clients. I know what's coming next for you based on more or less your demographics, your age, how much money you've accumulated in your lifetime. I put all this together, and I basically can tell pretty far in advance. And of course, I speak with clients about these matters too. So it's not like I'm not trying to say I'm clairvoyant. I don't know what you're having for dinner in 2 days. I don't know when you expire. I'm not saying I know these things. All I'm saying is that I just know what's coming next for you. When you go into retirement, I more or less know what your lifestyle is going to be like. I know which expenses go away, and I know that retirement usually costs a lot more than you thought. I know you're going to be so busy in retirement that you're going to say to yourself, how did I ever have time to work? And so these are the things. When somebody has children, I know what's coming next. Update your beneficiaries, life insurance, the time that you have for yourself. All of these things change when you switch jobs, when you have another life cycle transition, kids go to college. I know the things you're going through. I know the emotions that you're going to go through because I've been serving people like you for 31 years. So I just want to say it's not about market timing, and you shouldn't be about market timing either. What I'm saying is that what we really should be about, okay, what we really need to be about is making your changes to your portfolio, to your investments based on being ahead of your life cycle transition. So if you're retiring, for example, in 5 years, you shouldn't wait 5 years to lower your stock allocation and increase your cash and bonds allocation in your investment portfolio, for example. You should do it in 5. You should do it now in advance. You should know more or less, when my clients turn 50, I go over with them their social security statement of benefits. Now, some people say, oh, that doesn't matter. It's not up. But you should more or less know what to expect, because at that point, you probably have about 15 years left of contributing. And most people don't wait till they're 70 to start collecting on Social Security. So there's a bunch of things that we go over. And Jeff is out there as well. And Jeff is talking about business transition. Same thing, Jeff. And I know, Jeff, you're the expert in business transition and selling one's business. And my friend Jeff, who's, you can see his comment on the screen. Jeff's thing is, if you want to retire in 10 years, you have to get your business in shape now to make it attractive to a seller. You can't be, just like your own system of books and records and accounting. You've got to make it all official so that anyone else's accountant could come in, understand the books, and understand what's, the true nature and health of the business. That's that sort of thing. Okay. Sean is out there. Sean, thank you very much. What's your take on shorting GameStop now? Option puts are super high priced from the influx in volatility. All right. Look, Sean, here let me leave that comment up. When it comes to shorting, betting a stock that goes down, you could either short the stock, but conceivably, if a stock goes up and you're shorting it, I think you know this, but people who are watching this might not know. There's no limit to how high a stock could go up. So conceivably, your losses could be open-ended, could be unlimited. With a put, whenever you invest in the put option to bet a stock goes down, that's all you could lose. You put $10,000 or $500 or $5,000 or $50,000 or more into a put option, and the stock goes up. You have limited your loss to what you put into the put option. I think for a lot of people, that's a better way to go. I don't want to opine specifically on GameStop, but when a stock does what it's doing now and has massive volatility, in this case, this massive crazy move the stock has had, the option premiums on a stock like that, calls and puts, are typically going to have a lot of extra costs to them just because of the nature of the trading. So at this point, it's really just a matter of accepting if you want to pay the extra cost of shorting the stock above and beyond what the intrinsic value could be for the option. That's really the best I could tell you. I don't want to steer you wrong. It's a matter of personal choice, whether if you want to short it or not. A lot of people have been trying to short it and it keeps going up, and the company has gone from $2 to over $300. Even, no one believes that there's anything fundamentally changed about the company to justify this move, but it is a move higher that people have tried to game in the past, and they've gotten their faces ripped off. So it's just really a matter of how aggressive you are. And that's just why, you really need to be early in these things, I think, than to get into them late. Maybe the stock goes up a lot more, but once the short covering is over, and the stock is not worth what it is, the company's not worth what the market cap is, we've seen this before. It's probably going to plunge in value, and the Johnny-come-latelys are going to be left holding the bag. We've seen this before. Remember iOmega in the 90s? That's my example. All right, so that's my story, and I'm wrapping up here. Changes to your portfolio. I don't time them based on the stock market going up and down. But so you don't do some adjusting and rebalancing and changes around the margin. And I am an individual stock guy as well as exchange traded funds and asset allocation modeling. But by and large, when I make changes to clients' accounts, it's because I'm anticipating their life cycle transitions, and I want to be early in making those changes, not necessarily just make the changes because the stock market had a short-term blip up or down. Thank you so much for watching. I'll be back tomorrow. And if you have any questions that you think of after this, certainly hit me up in the comments. I'm also on Instagram. You can track me down there at InstaMitchG. And I'm on YouTube. It's the name of my business on YouTube, Client First Strategy. You can check out all my past videos, and I have a lot of 1, 2, and 3 minute videos that you could check out. And I'm on LinkedIn, and my Facebook is Client First Strategy on Facebook. And Sean says, thanks, Mitch. It's a game of musical chairs right now. That is a great way to put it. I agree 100%. All right, I'm going to end this broadcast. See you guys tomorrow. Thank you so much.